Hey everyone, this is Kirk here again at OptionAlpha.com. This is the members only video update, March 26th. So, lots been happening in the market, a lot of bullishness, obviously. The first thing I wanted to point out, because I've gotten probably 25 emails today on this subject alone. So, rather than email everyone back, I figured I'd just answer this question in a video update tonight to you guys. But everyone's talking about all these hedge funds and all the money that they're bringing into the market, and not necessarily hedge funds themselves, but mutual funds and equity funds and all the like. This is a really good, just quick article from the guys over at Business Insider about the last time that hedge funds bought this aggressively. And really what it kind of sums up is that hedge funds are actually not so concerned about buying right now. They're actually concerned about their clients calling up and taking money out of the market because the retail customer thinks that there's a top. So a lot of what's been driven in the market, apparently, has been a lot of hedge fund institutional buying, which we know because the market has been on a tear. But they've locked in some really good gains for the first quarter of the year. So don't be surprised if they start taking money off the table. That'd be the prudent thing to do, considering last year was absolutely flat and they made no money. If you actually look at the article, it's a really great article and sourced from Bloomberg, that the last time hedge funds were this bullish and pouring bets into the market was in April of 2010. Now, if we head on over to the charts, April of 2010 was right here. That's right when the market started to trade sideways flat to down for the rest of the entire year. So what a lot of people are saying and commenting about, you can read all the comments and all that stuff, is that we could be at the same type of area where hedge funds are starting to pour money into the market, but we could be at a plateau. And that's really all they're saying. Now, personally, I think that the bullishness today, even in the face of bad housing data, is something we shouldn't shy away from. I think that the market has been resilient in the past in that it's been continuing to make retracements of previous highs and break into new highs. One thing that I see all the time on here, and I'll just use my highlighter tool, is that the previous midpoint of these huge white candles seems to be a very good area of support resistance going forward. And so like you'll take candles like this that happened in early February, big day where we kind of really broke out into new highs. That area, that midpoint of that huge white candle acted as really good support going forward, right? We actually bounced off of it in March. Now just recently, again, we broke out higher, just about the midpoint. Actually, my drawing with this highlighter is a little bit low, but we came back down and bounced off that level. So now we're starting to break out again. It's not too far-fetched to think that this level around 1410 is going to be an area that the market continues to go higher and then tries to find support off of. These can be very, very, not dangerous markets, but very trending markets if they get into this pattern of breaking and retracing and breaking and retracing. So what you actually want to look for before we actually start to see a downtrend, which we still haven't seen and it's not really been breaking any lows, is that the market actually breaks beneath this support level and comes back up and retraces. That's what we want to see, right? We want to see a break below and then a retracement to confirm. Just a break below doesn't necessarily mean we're in a downtrend. We want it to confirm and hold that level and start to roll over again. At that point, then we know we're in a really safe downtrend, I guess, or starting to move the market over into a downtrend. Taking a look at some other things, obviously the VIX has been crazy low. You just can't get much lower than this. It's at 14. It's pretty much at near kind of all-time lows. If it starts to get into the 13s and God forbid the high 12s, then I'll definitely be buying some calls and some call spreads on the VIX. I think it's only prudent that you do that and maybe do it out a couple months into the summer when things get a little bit more volatile. But the VIX has been crazy low, which doesn't make it good for option sellers like us. Great time to buy volatility and hedging, though. Oil has been relatively calm. I think the main trend I see with oil is that it has these consolidation patterns before it breaks out. And so we saw this really back in November, December, January, right, where it had this trend. It was moving in this consolidation pattern. It broke out into a new area, and now it seems to be moving in a smaller, tighter pattern right now. So what I would look for on oil is just a break of this tiny channel that it's been trading in, almost like a flag or pennant pattern. It's made an initial move, It started to trend, and so if it makes another move, it's going to move about the same distance that it did previously, so about this distance here. And that would take us into the upper 40s, obviously, close to near 50. So watch for the breakout there. That could be really powerful, and again, could help lead equities higher if crude oil prices go up as well. Some of the other things I'm looking at, obviously, IWM. The Russell has been a little bit slow to the party, but is definitely taking off now. You can see that it's made a pretty significant breakout here today, which is why I want to do this video as well. The breakout on the Russell is pretty clear. I mean, you don't get much clearer than this. Some people are calling this an inverted head and shoulders pattern. It's not. Those happen at the bottom of a downtrend. Got a couple emails about that today. But it still does make the case for a nice, clean, solid breakout and accompanied by some higher volume. Not necessarily stellar volume, but it is higher volume. So again, we'll look for the Russell and the IWM to stay above this level, come back down and retest it before continuing higher. That's going to be the real key. Anything right now I wouldn't buy into. I'd wait and buy into it on the retest. So generally speaking, pretty light as usual. With the market, volatility is low. There's going to be plenty of time to make up for premium when volatility spikes, whenever that is. We just have to continue to move with the trend. I think our plan of just selling puts here and there has been really good. The one call spread we do have on the Russell is still pretty far away from the market, but everything else that we have as far as puts has been really good. Obviously, the market's been moving away, which has been great. Again, like I said, the one call spread we do have on the Russell at 910, 920 is still a pretty good distance away. Even though the Russell's broken out, it's coming right back into its previous highs from April, May, July of last year, so it's going to have some resistance and a tough time getting through this level. And that still is a pretty far stretch for the Russell to make in the next 25, 23 days. So overall, again, the bullish trend continues. We'll see when it stops. Right now, there's no clear signs, maybe some underlying divergence and stuff, but everything still remains very, very strong for equities. So just be careful of that. Don't take any short side bets just yet. If you want to start buying protection, now would be a great time for any of your put spreads later on. I think that starting to get positions a couple months out, long puts, may be a good opportunity to buy some hedge when you don't really need it. And that's the only thing I would do with those. But as always, we will wait and see when the trend turns, and then we'll start making our adjustments. Try to enter some more put spreads here later on this week. That's going to be the goal, considering the breakout. So as the market breaks out, we know that we have a good signal here to enter some put spreads below the market and let the market continue to run away from our positions. That only lets them decay faster. As always, if you guys have any questions or comments, please email me, and happy trading.